Hi everyone, welcome to the CFD trading course. We are on to lesson number 1. Lesson number 1 is an introduction to Forex and CFD trading. I'm really glad that you are able to join us on this first lesson, and we hope we'll continue this journey together until lesson 8. We have compiled this set of lessons to make sure that you become a successful Forex trader. Now, let us first look at our risk warnings. Trading foreign currencies can be a challenging and potentially profitable opportunity for investors. However, before deciding to participate in the forex market, you should carefully consider your investment objectives, your level of experience, and risk appetite. Most importantly, do not invest money you cannot afford to lose. That said, do not invest your emergency money. Only invest money you can afford to lose. Do not go out there and borrow money to invest in forex trading. This is because forex trading is a risky business. Okay, the exposure to risk is in every foreign exchange transaction. So you should carefully consider where your investment comes from. This should be money you can afford to lose. Now we will leave this risk warning here for a few seconds so you can go through them yourselves, and we will move on from there. All right. First of all, let us first explain the difference between trading and investing, because we understand that there might be a bit of confusion between trading and investing. So we will first start by explaining the difference between trading and investing. What is trading? Well, trading consists of short time frames. Okay. When you are a trader, you trade short time frames. You might trade over a day, you might trade over 5 minutes, you might trade over 15 minutes, you might trade over a week, you might trade over a couple of months or a month or so. But then those are short time frames. It is within a space of a year. It is within a period of a year. Another thing is that trading is based on price action. All right. When it comes to trading, we rely on volatility to make profit. If the markets aren't volatile, that means we are not making much profit. Right. And a lot of traders use technical analysis. Technical analysis is the reading of charts, the use of indicators to actually predict where the market is going to move next. All right. Trading is the use of technical analysis, and it requires volatility to make profit. In trading, you don't have to own the instrument. Now, let us say you buy gold. You don't have to own the physical gold, but you can buy it on the stock market or on the trading platform. Okay, you don't physically have to own the instrument. You're only speculating on its price. Okay, it is sensitive to noise, meaning it is sensitive to high volatility and unpredictable market. It is sensitive to that, because when there's too much noise, you can either lose your money quicker, and you can lose your money quicker. All right, so trading is sensitive to noise. All right. Another thing, when it comes to trading, you can make money whether the instrument falls or rises. Okay, when it comes to trading, you make money in both directions. Okay, when gold falls, you can make money. When the gold rises, you can also make money. All right. Now, what about investment? Okay, what about investing? Well, investments are over a long time period. All right. Somebody would invest in something over a long period of time. Let us take Bitcoin, for example. A lot of people had invested in Bitcoin 5 or 10 years ago. All right. They only started to take their money out when Bitcoin was rising like crazy. All right. Now, investments are over a longer time frame. All right. So it requires long time. Okay, people invest in a lot of startup businesses and only take out their money maybe 20 years or even 15 years later when the business has started making a lot of money. Okay, when the share price has increased. Okay, now investing is based on future value. All right, you're always banking on the markets rising, or the instrument you bought, or the company shares you bought. You're always banking that it should rise. If it falls, you lose your investment. Okay, that if it falls, that's your investment down the drain. But if it rises, you need to understand that means more money for you. All right, and investment is based on fundamental analysis. Now, what is fundamental analysis? Fundamental analysis is mostly the news. Okay, investments are affected by the news. Okay, if a president of a particular company says something to offend other people, okay, that means the company share price is going to fall. All right, and if a company announces something that the public likes, you have to understand that the company share will rise. Okay, it is always affected by fundamental analysis, the news, the climate, and all the other things. All right. Now, if you invested in a farm, it is affected by what? The climate. Okay. Let us say you invested in a farm that plants maize meal. Okay. If if we experience drought, that means your maize meal is going to be a problem. Okay. Your mealies aren't going to survive. So what happens to the farm? It loses money. So your investment takes a dip down the drain. All right. So investment is affected by fundamental analysis, and it needs long-term growth. Okay. It needs a long time. You need a long period. Okay. You need a long period of time before your investment actually grows. Okay, it doesn't grow overnight. It needs a lot of time, and you must own the instrument. Okay, if you're going to invest in gold, you must own the physical gold. Okay, it's either you'll put it in the bank somewhere, but you own it. If you want to invest in diamonds, you believe that diamonds will increase in value. You must have the physical diamonds in a bank safe somewhere or wherever it is that you put it. Okay, you need to own the physical instrument. That is investment. Okay, it is sensitive to news as we are right now. Assuming that a lot of you guys are new to trading, this is a chart. Okay, this is a daily chart, and this is how the chart looks like. All right, now this is how the chart looks like. When you get to the market, this is what you will see. Do not worry if you don't really understand what is going on. We will cover everything as we progress through the lessons. So do not worry. We will get on with it as we keep going. You will understand everything. Just relax and all right. Now, the first thing you need to understand is PEEP. That is the first thing you need to understand. A PEEP. Now, what is a PEEP? A PEEP is the smallest tradable price movement a market can make. Okay? A PEEP is the smallest tradable price movement a market or an instrument may make. Now, for example, let us say you want to trade Euro USD currency pair. Okay, you want to trade the Euro USD currency pair, and the current price is $1.3200. Now, what does it mean? This means for €1, you get $1.3200. Okay, for €1, you get $1.32. All right. Now, if it moves up 1 pip, okay, if it moves to 1.3201, that is 1 pip. Okay, a pip, when it comes to currency pair, a pip is the fourth decimal number. Okay, it's the fourth decimal number after the comma. Okay, it's the fourth number after the comma. That is a pip. Now, let us say you bought the Euro USD and it moves up 1 pip. It moves to 1.3201. That is 1 pip. Okay, it was on 1,3200 and it moves to 1,3201. That is 1 pip. A pip is the fourth decimal number in a euro in a currency pair. But remember, a pip location differs from instrument to instrument. Okay, so in a currency pair, pip is the fourth decimal number. All right, and then remember, a pip is the smallest tradable movement the market can make. Now you can see that the euro USD was 1,3200 and it moved to 1,3201. Okay, that is the smallest tradable price movement. It moved from 0 to 1. That is 1 pip. Okay, that is 1 pip. So now that is 1/100th of a percent. Okay, that is 1/100th of a percent. All right, you don't have to worry about the percents. You will get it as we go along. All right, but then a pip is the smallest tradable number of a price action. Okay, the decimal place may change depending on the instrument. Like I said, the pip location differs from instrument to instrument. Okay, but on currency pairs, you gotta understand that pip is the fourth decimal number. Now, in stocks, a pip is the second decimal number. Okay, in stock, we're talking about Facebook, Amazon, Apple, and all the others. All right, while in gold, a pip is the second decimal number. Now, gold is part of the commodities. Okay, do not worry, we will cover this as we go along. But in gold, the pip is also the second decimal number. While in oil, it is also the second decimal number. But in silver, it is the third decimal number. Okay, it is the third decimal number in silver. Okay, in Forex, it is the fourth decimal place. Okay, now Forex, we're talking about currencies. Whenever somebody tells you that I'm a Forex trader, that person trades currencies. Okay, although a lot of people use it interchangeably with just trading CFDs, but there is a difference between Forex trading and CFD trading. Okay, Forex trading is when somebody only trades currencies. All right, while a CFD trader is somebody who trades a combination of currencies, commodities, stocks, indices, etc. All right, that is the difference between a CFD trader and a Forex trader. Okay, that is why our course is Forex and CFD trading. We're going to teach you how to trade both Forex and CFDs. All right, now a pip is the smallest price movement an instrument can make. You should remember that. All right. So it depends on the market that you are looking at that you can determine. All right. Now, here's a more practical example. All right. We still have the Euro USD market. Okay. Now, you may see we have a sell price and a buy price. Okay. And you may see the difference in numbers. We will explain that later. But at the moment, let us look at it. Okay. Now, we can tell that this is Euro USD. Okay. It's a Euro USD currency pair. And that means it's what? It's Forex. All right. Now, a pip in the Forex market. Where is the pip located? It is located on the fourth decimal number. All right. That means we can see that. Let us look at the buy price. Okay. The buy price says 1,0719. Okay. That is, we gotta look at 4 numbers after the comma. Okay. After the comma, we have 0719. Okay. That means our pip is the fourth decimal number. Okay. That is a pip. So our pip will be what? The fourth decimal number. That is our pip. Okay. Now, a lot of people might ask, what about that small number? That small number there. Okay. That small fifth number. Okay. Because we had 1,07,173 on the sell price. Okay. While on the buy price, we have 1,07,191. Okay. Now we can see, let us look at the sell price at the moment because it is clear. We can see that it's 1,0717. And the 7 would represent the what? The pip. Okay. While, what about the 3? Okay. What about that small number? What is it? Well, that small number, we don't actually look at it. But if you want to know what it is, a lot of people would call it a mini pip, a micro pip, or a pipette. Okay, but we can call it what? A nano pip. You can call it a nano pip, a pipette, or a micro pip, depending on what you do, on what you want to call it. But it is a nano pip. We don't even look at it. Okay, we don't look at the fifth decimal number. All right, we only look at the fourth decimal number because that is our focus. That is the pip value. Right, that is the pip value. The fifth number is just a nano pip. Okay, it is good to know it, but remember, we don't even look at it. Okay, now let us look at a buying example. All right, we're going to use our numbers at our left, at our upper left hand corner. All right, we still have a Euro USD market. Okay, the reason we keep on using Euro USD is for consistency's sake. Okay, we want to use it for consistency's sake to make sure that we don't get you confused. Okay, we can use any currency pair, but we decide to use Euro USD for consistency's sake. All right, now the sell price is 1,4502, while the ask price is 1,4505. All right, now we're going to look at a buy example. So we're going to look at the what? The buy price, 1,4505. All right. Now, if you buy the Euro USD market, that means you believe the euro will strengthen against the dollar, which means with 1 euro, you're going to get more dollars. Okay. If let us say one euro is equals to $1,4505. Okay. If you buy the euro, you believe that the next time you go and buy the dollar with 1 euro, it's not going to be 1,4505, but it's going to be 1,45 or higher. Okay, you believe the euro is going to strengthen. Okay, now you buy at 1,4505, and if the markets went up to 1,4605, you profit. Okay, because now it means for 1 euro, you're getting more dollars. You used to get 1,4505, but now you get 1,4505. Okay, you've made profit. Okay, how many pips did you make? You have just made 100 pips, because when you say 1,4605 minus 1,4505, you get 0,0100, which means it's how many pips. You're going to look at how many pips you're going to make. It's 100 pips. Okay, you have just made yourself 100 pips. Now, if it had moved to 1,4506, you would have made 1 pip. But now it moved to 1,4605. You've made 100 pips. Okay, I hope that is clear. You have made 100 pips. In order to understand how many pips you made, you just have to minus the money you made. You just have to minus the money you bought with from the money you made. Okay, from your recent selling price. Okay, now within this case, you have made 100 pips. We have what is called spread. Now, what is spread? Spread is the cost of doing business. Okay, it is the money your broker charges you for using their platform. Okay, now a spread is charged every time you open a position. Okay, meaning if you don't have any open position, there is no spread charged. But as soon as you open a position, whether you are buying or selling, you will be charged a spread. Okay, now how do you determine your spread? Okay, how do you know how much spread is charged on this instrument? Okay, now you can determine that by looking at the price difference between the buy and the sell value. Okay, on the previous chart. Okay, remember I hinted to you that the sell price and the buy price went the same. Okay, that is because the difference between the buy price and the sell price gives you the spread charged by your broker. All right, now let's look at it in a more clear example. Okay, let us look at Euro USD. Okay, let us say the sell price is 1,1072, while the buy price is 1,1074. All right, now you can see that these two prices are not the same. Okay. Now, why are they not the same? Because the difference between those prices is the spread charged. Okay. To determine the spread charge, we have to say buy value minus sell value. In this case, it's going to be 1,1074 minus 1,1072, which gives us 0,002. Now, that is the amount of spread charged. Our spread is 2 pips. So basically, for every position we opened on EURUSD, we are charged a 2 pip spread. Okay, that is why whenever you open a position, it always starts on the negative. Okay, because the broker is charging you a spread. Okay, now let's say you open a 500 Rand position. Okay, and as soon as you open the position, it starts on a minus 19 Rands. Okay, it starts on minus 19 Rands, and you know for a fact that your EURUSD spread is 2 pips. Okay, and your position starts on minus 19. Okay, since you wanna now, let's say you wanna know how much 1 pip costs. Okay, you're going to say that 19 divided by 2, since you are charged 2 pips for EURUSD. Okay, you're going to say 19 Rands divided by 2, and you get 950. So that means every 1 pip movement is equals 950. Okay, for every 1 pip movement, you pay or you gain 950, depending on whether your position is winning or losing. Okay, now let us say on that position, on that 500 Rand position that you open, you manage to get 100 pips. You manage to bank 100 pips. Now, knowing that one pip is equals to 950. Okay, all you have to say, because you made 100 pips, you're going to say 950 multiplied by 100. And how much did you make? You have just made yourself 950 Rands profit. Okay, that is how easy it is to calculate how much money you're going to make, or how many pips how pips and money connect together, how to calculate the amount of money you're going to make. Okay, deriving from the amount of pips you've already made. Okay, now, okay, spread is mostly determined by the number of people who are trading and also by the popularity of the instrument, okay, that you're trading. Now, the brokers determine the spread by the popularity of that instrument. Okay, when you can check, EURUSD is one of the most traded currency pairs in Forex. Okay, that means that is why the spread is so little. That's why you have a 2 pip spread. Okay, because it's so popular. Okay, but then when you can look at cryptocurrency have a huge spread difference. Okay, you may be charged a $20 spread. Okay, a 20 pip spread. Okay, a 20 pip spread. That is because a lot of people aren't yet trading cryptocurrencies. Okay, and cryptocurrencies aren't that popular. Okay, I know a lot of people are always talking about Bitcoin and all the other things, but when it comes to the trading platform, cryptocurrencies aren't yet that popular. Okay, they are not traded by a lot of people. There are some platforms that still don't offer cryptocurrencies. Okay, so that is why when you find platforms that offer cryptocurrencies, the spread is too big. Okay, meaning on a 500 Rand, let's say you open a 500 position, it might start on minus 72 Rand. All right, knowing that, let's say you are charged a $20 spread, you can divide by 72 Rand by 20. You can tell how much 1 pip costs. Okay, now, okay, here's a quick question. Okay, let's look at something. Okay, looking at this EURUSD sell and buy price difference, can you tell me how much spread is charged? Can you tell me that? How much spread is charged here? Okay, all right, here's the thing. To determine that, you have to say the buy value minus the sell value, and you get a 2 pip spread. So that means your spread is 2 pips. Okay, and if you got this answer correctly, now let us move along. Okay, moving along, we have what is called leverage and margin. Leverage and margin, these are very much connected. Okay, leverage is a feature offered by the broker to help traders to trade larger amounts of securities or positions by having a smaller account balance. Okay, now I'm not sure if you're familiar with this saying. Okay, there is a saying that says, give me a long enough leverage, I can tilt the earth, or give me a long enough leverage, I can shake the earth. All right, now leverage allows you to trade larger markets, okay, larger amounts on the markets with only a small account. All right, now a broker might offer you a leverage of 1 to 50. This means they allow you to access the market at 1/50th of the actual price. Okay. To allow you to have access, they will request a deposit. This is known as margin or required margin. Okay. Margin is the required, it is the required deposit to open a position. That is the margin. Okay. Margin is a typical percentage figure. Okay. In this instance, let us say they gave you a 1 to 50 leverage. Okay. Or a 50 to 1 leverage. Okay. That means to trade a 50 rands position, you only need to have a 1 rand deposit. Okay. That means you can trade a 50 rand deposit with only 1 rand. Okay. Now, what is to 50th? It means you only have 2%. You only need to have 2% of the total position value. Okay. You only need to have 2% of the trade. Okay. Let us say, for instance, you want to trade 10,000 securities or 10,000 contracts of Euro USD. Okay. And they gave you a 50 to 1 leverage. That means you only have to have 2% of that 10,000. Only 2%. And how much is 2% of 10,000? That is only 200 rands. Okay. That is how brilliant leverage is. They allow you to trade larger amounts of securities with only a small account balance. Okay. Now, with a 1-to-1 leverage, okay, let us say they don't give you any leverage. The broker doesn't give you any leverage. You want to trade a 10,000 rand securities. Okay. You want to buy 10,000 rand contracts. Okay. Or 10,000 rand securities. That means on a 1-to-1 leverage, you need to have that 10,000 rands in your account. Okay, to trade that, you need 10,000 rands in your account. But with leverage, you only need 2%. Okay, with a leverage of 1 to 50, you only need 2% of that 10,000. All right, now let us look at leverage and margin. Okay, let us look at it in a table form. Okay, you get a lot of different leverage prices. Okay, each instrument is leveraged differently. Okay, brokers give different leverages. Okay, now leverage can move. Okay, let us just say you just invested 1,000 rands into your account. Okay, your account balance is 1,000 rands. You just invested 10,000 rands. Okay, with a 1-to-1 leverage. Okay, let's say the broker doesn't give you any leverage. Okay, it's 1-to-1 leverage. You have no leverage given. So the purchasing power is 1,000 rands, meaning you can only buy instrument securities or anything. You can only trade with 1,000 rand. Okay, you cannot trade any securities bigger than that. Okay, you can only buy 10,000 or 1,000 rands of contracts, 1,000 rands of securities. Okay, you can only buy that. But with a 50-to-1 leverage, okay, with that 1,000 rand, okay, you can trade securities as large as 50,000 rand. Okay, you can trade 50,000 rands worth of securities. Okay, with a 100-to-1 leverage, you can trade 100,000 worth of securities. Okay, because with a 50-to-1, you only need 2%. Okay, you only need a deposit of 2%. But with a 100-to-1 leverage, you only need 1%. Okay, with a 200-to-1 leverage, okay, you only need 5% of that amount. All right. Let us say you want to purchase 200,000 rands worth of contracts. Okay. You only need 1,000 rands. Okay. Which is the 0.5% of that. Okay. Now, with a 400-to-1 leverage, you only need to have 0.25% of the total amount of contracts or securities that you want to buy or sell. Okay. Meaning with leverage allows you to trade bigger markets with small deposit amount. Okay. So great leverage is. Okay. Leverage allows you to trade the markets easily. Okay. A lot of people wouldn't be able to trade the markets had they not been leveraged. Okay. Now you need to understand that leverage is good when you know your story. When you know what you're doing, leverage is the best thing that could happen to you. But when you don't know what you're doing, leverage can turn out to be your worst nightmare. But since you are in our course, we will make sure that you understand everything and you become a successful trader and you know how to use leverage to your advantage. Okay. Now we have what is called lots. Okay. There is what is called lots. Okay. These are standard contract sizes, whether you're trading Forex, currencies, commodities, or stocks. Okay. Lots are standard contract sizes. Okay. Now, we have three tradable lot sizes. Okay. We have three tradable lot sizes. We have a standard lot. Okay. Standard lot is 1.00 lot. Okay. It's one full lot. That is a standard lot. Then we have a mini lot, which is 0.10 lots. That is a mini lot. And then we have a micro lot, which is 0.01. Okay. Lot sizes and leverage, you need to understand lot sizes so you can be able to know how much leverage you need to trade. Okay. Now, you can change your lot sizes as you wish. Okay. Now, this is MetaTrader 4. This is an MT4 platform. Okay. We can change your lot sizes by simply changing the volume number. Okay. Now, as you can see at this position, look at the volume number. You can tell it's 1.001. Okay. Now, having it been 1.001.00, you can tell that that is a standard lot. All right. It's 1.00. That is a standard lot. And you can change it to 0.10, which is a mini lot. You can also change it to 1.01, which is a micro lot. Okay. All you have to do is click that drop down menu, and it will tell you, it will allow you to change your volume size. All right. Now, lots. Okay. Let's just say you were trading a standard lot. Okay. You're trading a standard lot size. Okay. If you were to buy one standard lot size of Euro USD, you would be buying 100,000 euros worth of dollars. Okay. That is one standard lot. If you're using one standard lot, you would be buying 100,000 euros worth of dollars. And if you were to buy with a mini lot, you would be buying 10,000 euros worth of dollars. Okay, because it's 0.10. Okay, that means you just divide it by 10 and then you get 10,000 rands worth of euros. And if you were to buy with a micro lot, you would divide it by 100. That means you would be buying 1,000 euros worth of dollars. Okay. Now, let us look at an example of gold. If you were to buy gold, okay, okay, with a standard lot, okay, that means you would be buying 100 ounces worth of gold. Okay, if you were to trade gold with a standard lot, you would be trading 100 ounces worth of gold. While if you were to trade it with a mini lot, which is that 100 ounces divided by 10, you would be trading only 10 ounces worth of gold. Okay, and if you were to trade a micro lot, you would say that 100 ounces divided by 100, and that would be, you would be buying 1 ounce of gold. Okay, a mini lot, which is 0.10, would be 10 ounces of gold. The micro lot, which is 0.01, is 1 ounce of gold. Now, lots and leverages. Okay, let us look at lots and leverage, the connection between the two. Okay, say you're trading gold at $1,100 an ounce. Okay, that means to buy 1 ounce of gold, it will require you to have $1,100. Okay, that is how much it takes to buy 1 ounce of gold. Okay, now to trade one lot. Okay, to trade one lot, remember 1 lot is equals to 100 ounces of gold. Okay, you're trading a standard lot. This is 1 lot, which is a standard lot. You're trading 100 ounces of gold. Okay, now to look at how many, you can tell that 1 ounce is equals to what? $1,100. Now you want to trade 1 lot, which is 100 ounces. That means you gotta say $1,100 multiplied by 100 ounces of gold. So to buy 100 ounces of gold, you will need to have $110,000 in your trading account. That is when the leverage is 1-to-1. On a 1-to-1 leverage, you need to have $110,000 in your trading account to trade 100 ounces. Okay, so to trade 1 lot, okay, which is 100 ounces, it costs you $110,000. Okay, this is how much margin is required to place 1 trade. Okay, whether you're selling or buying, it will require you to have $110,000 in your account to trade just that 1 lot. Okay, but then let us say the broker offers you a 50-to-1 leverage, which means you only have to have 2% of that 110,000. All right, you only have to have 2% of that 110,000. Okay, which means now you only have to have 2% of 110,000. And what is 2% of 110,000? That is only $2,200. Okay, so with only $2,200, you can trade 110,000 worth of gold. Okay, that means with $2,200, you can trade 100 ounces of gold. Isn't that remarkable? That's how much leverage allows you to trade. Okay, leverage ensures that you can trade larger market sizes or larger amounts of trades with only a small. Okay, now trading without leverage. Okay, let us say you're trading without leverage. All right, you bought 5,000. Okay, 5,000 worth of gold, remembering that 1 ounce of gold is equals to 1,100. Okay, 1,100. So to buy 5,000 rand worth of gold, you have to say that 5,000 divided by 1,100. Okay, that means you will have 4,545454 ounces of gold. Okay, which is not so bad. You're gonna have 4,54 ounces of gold. Now, since gold was 1,100 per ounce, okay, now gold rises to $1,150 per ounce. Right, now to see how much money you've made, you're going to say $1,150 multiplied by 4,545454, which is what? You're going to multiply it with the number of ounces of gold that you have, because gold have risen in price. That means you have now made $5,227.27. Okay, that will now be your account balance. Your account balance now is $5,227.27. Okay, now to see how much profit you've made, you will need to say $5,227.27 minus the balance you started with, which is $5,000. So how much profit did you make? You have made $227.27. Okay, you have made that much profit, $227.27. Okay. Now, is that a good enough risk? Okay, you have risked 5,000 only to make $227.27. Okay. When you look at it, it's not a good enough percentage. Okay. Risking 5,000 to get $227.27. That is way too risky. Okay, because your risk was much bigger than your gain. Let's look at it with leverage. When you're trading with leverage, okay, let's say your broker gave you leverage. Okay, you buy gold at $1,100 per ounce. Okay, but now you have a 1-to-50 leverage. Okay, you have 1-to-50 leverage. Okay, let's say you want to buy 100 ounces. You want to buy with a standard lot. Remember, a standard lot is 100 ounces. That is a standard lot. You want to buy this with a standard lot. Okay, so this means to have 100 ounces of gold, you need to say $1,100, which is 1 ounce of gold, which is the price of 1 ounce of gold, multiplied by 100 ounces of gold. Okay, that equals $110,000. Okay, to trade 100 ounces of gold, you need $110,000. But remember, you have a 1-to-50 leverage, or a 50-to-1 leverage, meaning you only have to trade with 1/50th of that required price. You only have to have 1/50th of that required price on your account, and that is 2% of 110,000. Remember, 2% of 110,000 is, that is 2,200. So you're going to say $110,000 multiplied by 2%, and that is $2,200. Okay, you only need to have $2,200 in your account. Okay, but remember, your account balance is 5,000. That is the amount of money you invested in your trading. Okay, so you're going to say 5,000 minus 2,200. That means you still have a balance of 2,800, while you only take out 2,200, which is 2% of that 110,000, to trade that position. Okay, now let us say gold rises to 1,150. Okay, gold rises to $1,150 per ounce. Okay, now remember, you no longer have 4,4545455454 ounces of gold. No, you bought 100 ounces of gold. Okay, so you're going to say 1,150 multiplied by the 100 ounces you have. Okay, that equals to $115,000. All right, what is your profit? Okay, remember, you only bought $110,000 worth of what? Gold. So you're going to say $115,000 minus $110,000. And how much did you make? You just made $5,000. Okay, you made $5,000. How much did you risk? You only risked 2,200. And how much profit did you make? $5,000. Just made $5,000 worth of profit. Okay, with a risk of only $200. Now, here's a little warning. There is a disadvantage of trading leverage if you don't understand your risk management. If you don't know what you're doing, you need to know how much to risk in order to trade leverage. But do not worry, as we continue through these lessons, we're going to take you through every step. And I believe risk management is on our lesson 8. Okay, so by the time you get to our risk management, you will know how you're supposed to do your trading. You will know how you're supposed to trade. Okay, so that means you will be excelling on your risk management. All right, so now, if you don't understand your risk management, you could face what is called a margin call. Okay, if you don't understand your risk management, if you trade without the understanding of risk management, you trade leverage positions without understanding risk management, you will be margin called. Okay, now what is what is that? What's that? Margin call. Well, a margin call occurs when you open positions encounter so much loss that the broker alerts you and closes your position. Okay, a margin call is when your open position loses so much that the broker alerts you and closes your position. That is a margin call. All right. Although this should never be allowed to occur to professional traders who understand risk management. So just because we're going to teach you how to risk manage your account, this should never happen to you. Okay, we're going to teach you how to manage your risk, and this will never happen to you. All right. Now, let us look at this on a Excel spreadsheet. Okay, let us look at this on an Excel sheet. How you come to actually be margin called. All right. Now, let us say this is a buy market. You bought gold. Okay, it's in the buy market. You bought what? Gold. You bought gold. Okay, your account balance was 5,000 rands. Okay, you bought gold. Now remember, 1 ounce of gold costs $1,100. Okay, and you bought one lot of gold. All right, it is leverage. Remember, your leverage is 1 to 50 leverage. You still have your 1 to 50 to 1 leverage, and you still bought what? One lot of gold. Okay, which is 100 ounces of gold. Meaning your investment is 100 and what? 110,000. But just because you have a 50 to 1 leverage, you are only required to only pay what? Your required margin is what? 2,200. Okay, you can see your required margin just below the account balance, which was 2,200. Okay, that was 2,200. Your account balance was still 5,000 because your account balance is your required margin plus your free margin. Okay, your account balance is your required margin plus your free margin. Okay, that is your account balance. All right, now let's say your position is still on zero. Okay, there hasn't been much movement. Okay, now if it's moved to your direction, okay, and the price of gold rises to $1,150. Okay, remember 1 ounce was $1,100. Now the price rises to $1,150. Okay, your profit and loss ratio rises to $5,000. You have just made $5,000 profit, and your account balance has just risen to what? To 10,000 rands. Okay, you had just made 10,000 rands because your profit is 5,000 rands. Okay, that is what happens when your position goes to what? To your direction. When it goes towards your direction, you bought and gold actually proved you right. You realize, okay, I was correct, and you made money. Okay, that's what happens in leverage. But then let us say for some reason the market moved against you. The price of gold falls. Okay, it falls from $1,100. Now 1 ounce of gold is now equals to $1,090. This means the markets are falling and you're losing. Your profit and loss ratio goes to minus 1,000. You're now losing 1,000 rands. Okay, just because your account balance is a combination of the required margin plus the free margin. Okay, remember your account balance is free margin plus the required margin. All right, now your account balance falls to 4,000 because your profit and loss is 1,000. Okay, the market continues. Okay, the price of 1 ounce of gold falls to $1,080. Now your profit and loss ratio is now minus 2,000. Okay, remember you are running out of what? Free margin. Your free margin goes down to 800. When you started, your free margin was 2,800. Now your free margin is 800. Okay, now you're counting on the market to bounce back, but no, to go down. Okay, Now 1 ounce of gold is $1,075. Your profit and loss ratio goes, now you are losing, okay? You are encountering a 2,500 rand loss. Your free margin goes down to 300 rand, okay? That's when you start getting alerts from your broker telling you that, listen, it might be time to actually close your markets because you are losing it. You are running out of free margin, okay? But you decide to have faith, okay? You decide to have faith and believe that the market is going to change direction, and the price continues to go down. Now every dollar counts, okay? Now the current price of gold is $1,074. Your profit and loss rises to 2,600. Your free margin goes down. You are running out of free margin. Now you have $200 rands worth of free margin. All right. Now you are nearing a margin call. Okay. You keep hearing alerts from the broker. Okay. Your current price is $1,074 per ounce of gold. It continues to go down. Now it goes down $1 more. Okay. The current price is $1,073 per ounce. Now you are really losing your money. Okay. Now you only have 100 rands worth of free margin. Your profit and loss is minus 2,700. Okay. You only have $100 rands worth of free margin. If you just go down $1 more, you have to understand that the broker will definitely close your position. And you decide to hang on, the market goes down $1 more. Then the price of 1 ounce of gold goes to $1,072 per ounce, and your profit and loss goes to minus 2,800, and now you are out of free margin. And guess what happens? You get margin call, okay? Because you no longer have free margin and your broker decides to close your position, you get margin call. Okay, that's when all your position get closed and you're out. Which is why it is really important to understand your risk management when it comes to leverage trading. Okay, when it comes to trading leveraged markets, you need to know your risk management. Okay, you need to know how much you're risking, why you're risking that amount, and why you enter in that position. Okay, you need to understand your how and why and the what. You need to understand the how, the why, and the what. Okay, how are you going to trade? What markets are you going to trade? What position are you going to open, and why? Okay, the why has to be like the technical analysis. Your technical analysis support your position, and also your fundamental also support it. Okay, the fundamental, remember what fundamental analysis is? The news. Okay, the news supports your decision. All right, so since we've covered the PEEP, leverage, the spread, now let us come to the biggest question yet. What can you trade really? What can you trade in the Forex and CFD market? What can you trade? You can trade currencies. Remember, what are currencies? Currencies is Forex. Currency is Forex. Okay, you can trade currencies, right? Forex markets are very liquid. Okay, Forex markets are very liquid. They're very popular, matured, and developed. That is the currency markets. They are very liquid. They are very popular, matured, and developed. Okay, you can enter and exit trade easily rather than waiting for a counterpart. That is the beauty of trading Forex. Okay, many traders who are familiar with their own currency can compare it with other currencies. Okay, many traders are familiar with their currency and they can compare it with other traders. Okay, that's the thing. Anybody from any country understands their currency when it is compared to other currencies. All right, they understand that completely. All right, now Since a lot of us are from South Africa, I'm sure you guys are familiar with how much the rands cost against the dollar. Okay, we understand that it is playing around that 16 rand 97 mark to 17 rands. Okay, a lot of traders are familiar with their currency. Okay, traders who are from Singapore understand how much the Singapore dollar costs against the US dollar. Okay, just as traders who are in India understand how much the Indian rupee costs against the US dollar. Okay, against the euro, against the pound. Just as we understand how much the rand costs against the US dollar, the pound, the Indian rupee, for example, we all understand that. Okay, so it is easier to trade forex when you are even a new trader. All right. Now, traders can relate to the trajectory of currency based on economic factors. We understand that economic factors affect our currency. All right. We can also understand how much the coronavirus pandemic affected a lot of currencies. We know how much the coronavirus affected the South African rand. Okay, because the South African rand fell from 14 rand 50 to around about 17 rand 30. Okay, that's how much the coronavirus affected them. Those are the economic factors that affect the currency pair. Okay, if you understand that, trust me, you are going to be really successful. But it is easier to trade currencies because we understand all that. All right. Okay, a lot of popular pairs have low spread. Okay, trading currencies is brilliant because a lot of popular pairs have low spread. As we've seen, the Euro USD has a $2 spread. Okay, and I believe the Euro JPY also has about $4 spread, or a lot of things. Okay, they have a small peep spread. Okay, what other thing can you trade? We can trade commodities. Okay, commodities are other set of instruments that we can trade. Okay, now we have energies. Okay, in commodities we have energies. Okay, energies are oil, Brent crude oil, natural gas, and more. All right, we have energies, and then we also have metals. Okay, by metals we're talking about platinum, gold, silver, copper, etc. Okay, those are the metals. And then we have soft commodities. Soft commodities, we're talking about coffee, soybeans, corn, wheat, and more. All right, and then we have extra soft commodities, more soft commodities. We're talking about sugar, livestock, and cocoa. All right, those are. Now let's look at these commodities individually. Okay, let us start by looking at energies. Okay, energies are highly volatile instruments. Okay, remember energies, we're talking about oil, Brent crude oil, and natural gas, and more. All right, energies are highly volatile instruments. This is because they are mostly driven by two major factors. Okay, what are these factors? Location. Okay, commodities are driven by two factors. One of these factors is location. They are often produced in areas of political and economical instability, creating supply side difficulties. Okay, where are these places? That is North Africa and the Middle East. Okay, these are areas of political and economical instability. Thus, they create supply side difficulties. Okay, so that is the reason why energies are so volatile. Okay, and also the global outlook. Okay, global outlook also affects why energies are so volatile. Okay, microeconomics dictates, okay, assumed future demands. Okay, microeconomics dictates assumed future demands. Okay, now a lot of things is that there is too much speculation around oil and other things. Okay, a lot of people say that oil will fall because of the rise in electric cars, right? For example, a lot of people believe that we will soon come to a time where we no longer need oil. Okay, where oil is no longer that necessary, where oil will no longer be in high demand. All right, now those are microeconomic speculations. Okay, now those are macroeconomic assumptions. Okay, let's say we have seen, like, during this coronavirus pandemic, oil fell hard. All right, because the demand lowered. Okay, people were no longer driving to work, people were no longer driving so much, so oil was no longer in high demand. Okay, it's only when there were recoveries around the world that people started going back to work and oil gained. All right, those are the factors that affect oil, and those are the factors that lead to why oil is so volatile. All right. Now, there is still a lot of speculation around oil, so you should always make sure that you understand a lot of things when you start trading oil. All right. Now, commodities, we're looking at precious metals. Okay, let us look at precious metals. Okay, these include platinum, gold, silver, copper, and a lot more. Okay, now metals are quite volatile. Okay, as sentiment swings. Okay, metals are quite volatile as sentiment swings. Okay, traders tend to flock to gold in times of hardship. This is called a flight to safety. Okay, a lot of people believe gold is a safe haven whenever we're facing tough times. Okay, a lot of traders go and start trading gold when we are facing tough times. Okay, this is called a flight to safety. Okay, there was also news that China, India, and other countries, they were also buying gold because they had lost confidence in the US dollar. All right, that is because they believe that the gold will be the new safe haven. They'll be the new stable currency. Or they believe we'll go back to using gold. So a lot of people go to gold in times of hardship. Okay, this is called a flight. Let us look at soft commodities. Okay, what are soft commodities? Soft commodities are pulled from the ground. Okay, like energies, they offer some excellent moves as underlying factors affecting movement tend to change quite rapidly. Okay, soft commodities, we're talking about coffee, we're talking about soybeans, and we're talking about other things. Okay, they are everything that is pulled from the ground. Like energies, they offer some excellent moves as underlying factors affecting movement tend to change quite rapidly. This typically happens through one or more of these factors. Okay, now that includes supply and demand. Okay, now let us look at supply. Supply, we're talking about weather patterns. Weather patterns affecting produce regions. Okay, now a lot of cocoa is produced in Africa. Okay, and a lot of African countries are mostly affected by global warming. Okay, if global warming hits one of those countries, that means the cocoa supply will decrease. Okay, and with a decrease in the supply leads to an increase in the demand. Okay, and another thing that affects the supply is pest-related matters. Okay, pest-related matters. Okay, if we encounter pest infestation, we know that a lot of crops are going to die. Okay, and that means we will have low supply, and with low supply, with low supply comes an increase in demand. Okay, if we have low supply, we know we're going to have a higher demand, and if we have a higher demand, we have a lower supply. Okay, now if we have a higher supply, okay, so looking at the demand, okay, global demand based on economic outlook. Okay, the global demand based on economic outlook, that means, let us say, more people move to the cities. Okay, that creates a really great demand because of the economic outlook. Okay, if the number of people of a certain country increase, that means we have a higher demand of food, we have a higher demand of security, we have a higher demand of a lot of things. Okay, now the global demand is based on the economic outlook. All right, now if a lot of people lose their jobs, okay, that means many people won't be afford to buy a lot of luxury things, or they won't afford to buy food. Okay, we will see a lot of people staying on the streets, and that will actually impact the global outlook. Okay, now safety concern related to consumption of particular commodities. All right, if a lot of people are now eating corn instead of rice, that means we'll see an increase in the demand of what? Corn, and a decrease in the demand of what? Rice. Okay, those are some of the things that affect soft commodities, supply and demand. And we have stocks and indices. Okay, stocks and indices actually go really hand in hand. Okay, stocks, which are also called equities. We're talking about Google, Apple, Facebook, Amazon, and all the others. All right. Now, since equities are traded on an exchange, they have an opening and closing time for trading. Okay. Shares and equities are designed to raise operating capital for the issuer. Okay. Speculators invest to gain return. All right. Now, let us look at indices. Okay. Indices, which is a plural for index. Okay. We talk about S&P 500, okay, which is the top 500 companies in America. And then we talk of the German 30, which is the top 30 companies in Germany. We talk about the FTSE 100 in the UK, the ASX in Australia, and more. All right. Indices is a collection of big companies, okay, that have decided to trade alongside one another. Okay. Market indices are essentially groupings of top listed equities of popular exchange markets. Okay. And the average value is similar to the relative price. All right. We have a lot of people who are trading the S&P 500 totally successfully. All right. We have a lot of people who are trading the German 30, and I also trade the German 30 really successfully. Okay. I love trading the German 30 because you have to understand the German 30 is also very volatile, but then I trade it successfully and it is quite brilliant. Okay. Now, market, you can trade stocks, you can trade indices. All right. Stocks, we talk about Google, Apple, and Facebook, while in indices, we talk about the S&P 500, the German 30, the FTSE 100, the ASX 200, the DAX, and more. And we're even talking about the NASDAQ, which is the biggest tech companies. Okay. Another thing that a lot of traders trade is the cryptocurrency. Okay. Remember, I told that the cryptocurrency is not that popular yet and has a big spread, but then a lot of people also trade them successfully. We're talking about the Bitcoin, Ethereum, the Neo, the Litecoin, and more. All right. Cryptocurrencies tend to be quite volatile. Okay. And another thing is that they aren't yet matured, so they have a huge spread, meaning they are somewhat expensive to trade. Okay. They are open 24/7 with many trading brokers. So you can trade them anytime. Okay. You can trade them from Monday. And then we have government bonds. You can also trade government bonds. Okay. Governments have borrowing requirements in order to run their affairs. Some manage this better than others. All right. Oh, so what the government goes to the marketplace and seeks funding for a fixed period. Okay. This can be anywhere from 1 year, 2 year, 3 year, 4 year, 5 years, or even 10 years. All right. Now, the market dictates the price given the economic outlook of a particular region. Okay. And the commercial outlook in general. Okay. So, meaning if a country is doing great, okay, economically speaking, that means they will be charged lesser. Okay. So, and if the country's economic outlook is not so good, that means the country will be charged more. This is because investors want to be compensated highly for their risk. All right. Okay. When there is greater risk associated with that region, that rate becomes higher as investors demand greater yield to justify their acceptance of the risk. You can trade bonds via CFDs. That means you can trade them every day whenever you feel like trading. All right. You can also trade bonds just and commodities, stocks and indices, as well as cryptocurrencies. Now, here's what you can trade. Okay. You can trade currencies. You can trade commodities. You can trade stocks and indices. You can trade cryptocurrencies, and you can also trade bonds. Okay. You need to find whichever works for you and stick with it. Okay. Find a strategy that works for you and trust the strategy. Stand by it. Continue your trading the way you believe suitable for you. All right. That is a wrap on lesson number 1. Okay. We hope you really understand the introduction to Forex trading, and we will be moving to lesson number 2. Okay. In lesson number 2, we will be covering candlesticks. That means we are now starting to get deeper and deeper into Forex trading. You will get to understand everything there is. Okay. Like we have explained on our welcome video, after every lesson, we always hold a live class. Okay, a live class ensures that you are able to ask us questions live, and we are able to answer your questions live. Okay, another thing is that if you have other questions, you can also send them to us via WhatsApp. Okay, and we will do our best to answer them as soon as possible. Okay, do not miss the live class. We hope to see you then. Okay, that is it for today. Thank you guys. See you on the live class.